This is the really good stuff. Today we bring it all together so you can see the true beauty of how the Index Universal Life products protect you. Do you remember our math doesn't equal money conversation? If not, you may want to review the video from page 22. From there we talked about sequence of returns, which is on page 23. Today I'm going to show you how those two concepts work with a cap and a floor added, plus the benefit of never killing compounding interest. So why is using an IUL safer for pulling an income stream than pulling the same income stream out of an asset that can lose money? Let's assume that we have $1 million. We saved it for retirement that we need to provide us with a steady retirement income. I'm going to show you pulling an income stream off of a 100% stock portfolio. We're going to use the S&P 500 Total Return Index for this account. We're going to use the last 30-year history for that index from 1985 to 2014. We're going to ignore taxes, trading costs, management fees, and loads. I want to focus solely on sequence of return risk. With no withdrawals or expenses, our average rate of return from 1985 to 2014 was 12.83%. The actual return averaged 11.33%. To show you that my calculator is working correctly, without adding any expenses and no withdrawals, $1 million will grow to $25,009,793. Now, I'm going to invert the returns. Rather than going from 1985 to 2014, I'm flipping the history upside down and we're going to look at 2014 to 1985. Notice that we have the exact same $25,009,793. Isn't that interesting? The first time I saw this, I didn't believe it. I had to go through it line by line. But without expenses, withdrawals, or contributions, the sequence of returns doesn't matter. This really got me thinking. There has to be a way to use this knowledge to my advantage. Now, no one can invest for free, and we all have our not-so-silent partner, Uncle Sam. But once again, to keep this simple, let's ignore expenses and taxes. We can all agree that with expenses and taxes, your money isn't going to last as long as I'm about to show you, right? Great. Most financial planning is done with an average rate of return. In this example, our actual history was 11.33%. So I'm going to give this account a linear rate of return and then pull $100,000 per year off of the account. As we would expect, this account will last forever and will grow over time. At the end of 30 years, with our linear rate of return and a constant annual withdrawal of $100,000, our account balance is $1,417,726. Just as we anticipated, with consistent returns, everything works great. How many of you have ever heard of the 4% rule? This is a Wall Street probability calculation. It backtests a portfolio hundreds of times to see what the probability of you not running out of money is. It is not a guarantee. This is a chart of the 4% rule on a 50-50 portfolio. That is 50% stocks and 50% bonds. If a couple is retiring at age 65, there is a 50% probability that one of them will still be alive in 25 years. There's also a 25% probability one of the two will still be alive in 30 years. So looking at 25 and 30 years into retirement, if this couple were to pull 3%, 4%, 5%, 8% off of their account, that is $30,000, $40,000, $50,000, $80,000 a year. As we look out 30 years at the 3% line, there's about a 99% probability that this couple won't run out of money. But at the 8% line, there is a 90% probability that they will run out of money. Notice that all the lines are angled down. Even at 3%, most clients will be eating into their principal. There will be some that will get lucky and have more than they started with, but most will wind up with less and possibly even deplete their entire nest egg. It all depends on the sequence of returns. Are you willing to work your whole life to save enough money to retire and then take the risk that you'll become a statistic? I know that there are some of you out there who are saying, Merle, I would never draw an income off of a 100% stock portfolio. Okay, this chart shows you that the greater the percentage of income that you pull, the more stocks you'll need in the portfolio to have a higher chance of success. Notice that the 7% withdrawal rate with the 100% stock portfolio gives us a 39% probability of making it, and a 50-50 portfolio only a 14% probability. And a 100% bond portfolio has a 0 chance of success. Today, bond rates are near historical lows. The 4% rule is actually closer to 3% than 4% today. Most Americans can't afford to save $1 million for retirement and only take a 3% distribution off of it. They'll need more income than that just to maintain. Back to our sequence of returns conversation. We are looking at 1985 to 2014 historical data for the S&P 500 Total Return Index and trying to pull $100,000 per year off of this account. As I turn withdrawals on, this is one of those periods of time when sequence of returns worked. Not only did it work, but this client wound up with more than they started with. 1980 to 1999 was a strong market. It was in the year 2000, year 16, before this portfolio had a double-digit negative year. We had high interest rates, along with the baby boomers stuffing loads of cash into their qualified plans, trying to save enough money for retirement, which drove the stock market up. Today, we have low interest rates, so we can't live on our interest. And there has only been one market correction in the past 15 years. How likely do you think it is that for the next 20 years, we'll have those types of returns while the baby boomers are moving from saving money in their retirement account to consuming their nest egg? What happens if we invert the returns? If I invert the returns, this portfolio runs out of money in year 20. The 2008 negative 37% return puts this portfolio into what I call a death spiral. Not only did we lose 37%, but we withdrew $100,000 in the same year. It is almost impossible to have a portfolio survive that. So if you could, you would have to adjust your lifestyle down. If you can't, well, that's a place I don't ever want to be. So this is an example of sequence of returns that actually run out of money. So the question is, how does an IUL protect against sequence of returns? The reason the IUL works so well for retirement is that you never have to kill compounding. When you take a loan against your life insurance policy, the insurance company places a lien against your death benefit. Your accumulation value continues to grow based on the full value. There are some expenses, normally 0.2 to 0.4% of your account value, but nowhere near the 3 to 10% that we've been talking about so far. So the sequence of returns is as close as we can get it to being irrelevant. Remember our earlier conversation? With no expenses at all, you wind up with the exact same amount of accumulation cash, regardless of the sequence of returns. So as we look at the life insurance contract, this is a $500,000 bucket, maximum funded, and the minimum death benefit that the IRS will allow for this 45-year-old standard male non-smoker is $2.4 million. I used a 0 crediting rate in year 1 and a 6.88% rate of return from years 2 until the contract matures at age 120. I started pulling $100,000 of cash, income tax-free, from the IUL starting at the beginning of year 21 or age 66. I didn't inflate the income just because I wanted to be able to keep the total income distribution easy to calculate for everyone. At the end of year 20, our account balance is at $1.249 million. $100,000 divided by 1.249 equals 8%. I'm going to pull an 8% level distribution out of the life insurance policy starting at age 66 and going all the way to age 120. That's 55 years, not 30, if anyone's still counting. Please don't try this with your brokerage account. Remember that I just explained to you that if you distribute an 8% payout over a 30-year period of time, we would have a very high probability of failure. And if you did that with a portfolio exposed to a sequence of returns, that is an absolute. But with the IUL, we never kill compounding, so sequence of returns doesn't matter. We're looking for consistency, and because the cash doesn't come out of the account, it can stay there and work for you, even if you've already spent it. Isn't that cool? You just learned something most people have never heard of or understand. I'm going to drop down to year 40 in the illustration so that there is a big spread between the accumulation value and the surrender value. The difference between these two columns is the amount of income that has been pulled out of the contract, compounding at a contractual guaranteed 5% interest rate. Just for this example, by year 40, we've already distributed $2 million, 20 years times $100,000 in distributions. Our accumulation value is almost $5.1 million, and our cash value is showing about $1.6 million. At the end of year 39, our accumulation value was about $4.8 million. We are assuming a crediting rate of 6.88%. $4.8 million times 0.068 equals $330,240. Now that is what I would expect to have credited without expenses. But remember, I'm paying for as little insurance as possible. So our estimated credit for the year is actually $329,965. Not too shabby while I'm out fishing. Notice that our expenses during year 40 are $14,055. Now that may sound like a lot of money, but let's talk about what I'm getting for $14,000 that year. First of all, $14,055 divided by 5 equals 0.00278. That is 0.273% or a little more than 1/4%. For 0.273%, I have my money growing without any stock market risks because of the zero floor. I have tax-free access to my cash value, and I have upside potential in multiple index options. Or I can choose the fixed interest crediting option. Name another asset class that gives you just those options for about 1/4%. I'm telling you, it just doesn't exist. We have distributed $2 million of cash. We still have about $1.6 million of cash that we have access to, plus a death benefit for our heirs of another $250,000. At this point in time, that is $3.86 million in income tax-free benefits. This illustration runs all the way to age 120 and it shows almost unbelievable numbers. This is why I call this product my family financial miracle. To recap, this all works because the insurance companies place a lien on our death benefit, allows our money to accumulate and work for us, uses a cap and a floor in an equity index, and because of this strategy, we never kill compounding.